Hello everyone, welcome back. I got some really good ones for you this evening. But first, I hope you had an awesome week and you're having an awesome weekend as well. Lot to cover, let's dive right in, shall we? Markets. The three major US stock indices remain under pressure from these rising bond yields, rising interest rates, rising relative strength of the dollar, rising mortgage rates. All this instability in the dollar market, debt market, is sending shockwaves out to the end of the risk curve. So like stocks, Pokemon cards, gold, Bitcoin, your left shoe, and it's causing all the price tags of those things, real estate, to come down. I say Fed's about to flip like tomorrow. The Fed is going to pivot away from their hawkish stance now that they've front-loaded some of these more aggressive rate hikes, these 75 basis points, 75 basis points, 75 basis points. Like, the Fed's been raising interest rates all year. It's really beating up these markets. And now we even have like the Bank of England moving back to a loose stance with regard to monetary policy, quantitative easing coming back for them. We have weakness in the Japanese yen. These other countries' currencies and central banks just can't handle the Fed tightening. And frankly, the Fed can't handle the Fed tightening. The Fed tightening this much has freaked out a lot of players at the table, caused those mortgage rates to hit about 7%, putting real estate in America in the danger zone. Borrowing costs are just getting too high in order to justify such bubbled up price tags for all these different asset classes. So now that borrowing costs continue to move higher, these price tags just got to start coming down, and we've been seeing that. But the catch is, we've been seeing that for the last 9 months. Fed's tightened way more than I ever thought they would have tightened. It's time for them to pivot. There's rumblings that they're going to pivot. There's been a little bit of change in their tone. Fed Evans this week, sounding a little bit more dovish. I think it's time for the Federal Reserve to stop being so hawkish and flip more dove, meaning stop raising interest rates 75 basis points at a meeting. Let's try on some 25 basis point hikes, maybe a 50 here and there, but let's do some baby bumps, if any at all. Wouldn't surprise me if starting this week, mortgage rates start to come down, bond yields start to come down, interest rates start to come down because the Fed starts to flip dove. I'm looking for that because at this rate, things are starting to break. If the Fed keeps tightening and raising interest rates in their quest to solve the inflation problem, they're really gonna destroy their financial system globally. So I would expect the Fed to pivot, the dollar to get weaker, inflation to get worse for other countries government issued currencies to get weaker, and then I would expect Bitcoin to perhaps start going up, NASDAQ start going up, oil to start going up, gold to start going up, and real estate price tags to start going up a little bit too. All of these asset classes have been under a lot of pressure lately, especially this year. It's time for the Fed to stop letting air out of the tires and start blowing some back in. It's gonna make inflation worse, gonna push up asset prices, gonna be good for asset price owners, and bad for people whose wages are like pegged to like the dollar. So that's kind of what I see going on. We have, but I could totally be wrong, okay? If you think I'm going to be wrong, which, we can only deal in probabilities, then look for the 10-year yield to keep rising. Look for the 2-year yield to keep rising and maybe even invert more. Look just for bond yields to keep rising, interest rates to keep rising. Look for the Fed to remain, steadfast in their fight against inflation. Look for more interest rate hikes at every meeting. But I don't think that's going to happen, okay? If you think that's going to happen, I'd expect the dollar to get stronger. I'd expect more margin calls in liquidity events. We had some UK pensions get hit with some margin calls recently. That's just what happens when these pensions that are starved for yield and need to kick out profits to their pensioners and beneficiaries, they have to get levered up because they're chasing yield. It's just, these bond yields have been so low, these interest rates have been so low, they've had to take on more leverage, more risk. And then now that yields in the UK debt market are climbing, it's starting to create margin calls. I've been a margin trader before. I have quite a bit of experience trading on margin, not trading on margin anymore. Warren Buffett said something about margin that kind of stuck with me, even though not a lot of what Warren Buffett teaches me does stick with, you know, I don't worship the guy, all right? He's cool, read his books, intelligent investor, da-da-da, it's all good in the hood. But I don't worship Warren Buffett. But I do like this one thing he said about margin. He says, if you're smart, you don't need it. And if you're stupid, you shouldn't be using it. So I think that sums up trading on margin or leverage pretty well. I didn't incur windfall losses when I was a margin trader, but I did survive. We'll talk about some of my W's and L's at some point in another video in the future. But anyway, I've traded with margin before, and I gotta say, it changes up your mental game. It changes up your risk tolerance a lot because you're trading with borrowed money. You're trading with money you can't afford to lose, okay? And the person that loaned you that money, if he sees you making risky investments or watches your portfolio of his money tanking, he has the right to hit you with a margin call, which is basically boot you out of the chair of your prop trading desk, sit down and just start indiscriminately placing sell orders until they've raised enough cash to meet the margin requirement and basically have enough collateral pledged. Let's do it. Let's get down the rabbit hole. I'm gonna try to explain to you at an individual level what being a margin trader would look like. And then we can kind of talk about what happened to the UK pension plans, and then we can talk about those liquidity events effects on markets and price action and the dollar. So cool. This will be a good video. Okay. So you have $25,000 in this example. I give you $25,000. You start a little Ameritrade account. It's all in cash. $25,000 is just sitting there. If you can make 1% a day on that $25,000, you're making $250 a day, which in most jurisdictions would be like a pretty good living / target to shoot for. So you're making $250 a day on your $25,000 in cash. You're making your 1%, so that's $250. And then let's say I come to you and I go, how about you keep making 1%, keep that up, you're doing great, but you do it on $100,000, so you make $1,000 a day. Then you can start driving like nice cars and like really flexing on them, and you don't have to change a thing because you're trading with this $25,000 I gave you in cash. You're making 1% a day. That's $250 a day. You're doing all right, but let's see if we can level your game up. How about I give you an additional $75,000, and now you have $100,000. And you're making 1% a day, which is $1,000 a day. And you say to me, okay, yeah, absolutely. I already know how to make $250 a day. Why not call it $1,000? I loan you the money. Now this is interest-free money. So now you have $100,000 in buying power. And you're like, heck yeah, I can 4X everything I've been doing. And I'm looking over your shoulder. My job, because I just loaned you $75,000, like this is not money I'm giving you in this part of the example. This is just loaned money. So now this person with 100 grand is a margin trader. If they take a drawdown on the first day, let's call it $2,000. So they started with 100 in the morning. At the close, they only had $98,000. That $2K that they lost, that $2,000, that's not coming out of the money I loaned. That's coming out of your $25,000 cash position that you originally started with. You only put up $25,000 in cash. I loaned you the other 75. So when I see you lose 2,000, I'm not going to be like, great, keep losing my money. I'm going to go, cool, now you only have $23,000. So it magnifies everything. When you're a margin trader, your wins, when you're winning, you're really winning. But when you're losing, you're really losing. And so if I'm trading on margin, I have to be able to pledge a certain amount of cash in my account to make sure that I don't lose somebody else's money. Like Barry, the bank manager who loaned me money to become a margin trader, he ain't gonna let himself lose. And so let's say he loans me 100K, now I'm a margin trader, or he loans me 75,000 and now I'm a margin trader with $100,000 in buying power every day. Let's say Barry, the bank manager, did that for me. If I start racking up losses, that's only gonna come out of my money. But if I win, hey, if I'm winning, I'm winning. So Barry, the bank manager, doesn't care. Like if I just start making $1,000 a day, if anything, he'd want to lever me up more. He'd be like, good, you're a winner, like, keep going. But if you start to lose, he's just taking it out of the money that you originally put up. But let's say I took that 100,000 and I put it all into Apple stock, 100% of into Apple stock. Barry, the bank manager who loaned me the money, is going to go, dude, you have all 100,000, in Apple. If that position, like Apple stock, really starts to tank, Barry needs to make sure that he doesn't lose any of the money he loaned. So he's going to hit you with margin calls, and he's going to sell enough shares of Apple to make sure that there's just no way you're going to lose more than $25,000. Because in that example, that's your original cash in the account. Basically, the house will lever you to the hilt, and they'll give you as much. They don't care. They'll give you all the money in the world. But they're going to make sure, they're going to try to make sure, because believe me, anything can happen, that you're not able to lose all of your money and then start losing theirs as well. They're just trying to magnify your gains, and then when you end up ultimately magnifying your losses because trading on leverage like messed up your mental game and messed up your trading strategy, and like you just, position sizing went out the window, and you just really start jamming yourself up. Barry the bank manager doesn't care, because you're just losing your money. You're just losing your own money quicker. They don't care. They'll kick you out of that chair as quick as they can. As a matter of fact, Barry the bank manager ultimately wants to transfer all of your wealth and trading capital into his account. Trading isn't a zero-sum game. It's not, because the Fed's always pouring more money in from the outside, but it almost is. Meaning, if I have $25,000 and then I'm trading tomorrow, and then I close the day at 20,000, that $5,000 didn't die and go to money heaven. It went to somebody else. It was just transferred from my reality to somebody else's. So trading's not a zero-sum game, because the Fed's always pouring money in from the outside, but it almost is a zero-sum game in that respect. So anyway, you have all these pensioners in the UK, these pension funds, and they're like trying to make a decent yield on all this money that's in quote unquote safe bonds. And they're like really stretched to make yield. So what they need to do is borrow more and then try to make more on the money they borrowed, and then kick out those profits to the people who are on a pension plan and getting, paid till they die or whatever the pension plan states, The idea of the pension plan being like, you retire, don't worry, we're going to give you money every month. Like, you've been with the company for 25 years, you're on a pension, here's just money till you die. Well, the firm needs to generate money to kick to those people. And when they were starved for yield, they started to lever themselves up as much as they could. But then as soon as something goes wrong and bond yields start to skyrocket, they get pushed out of these massive positions. And when they get forced liquidated on these massive positions, that's a flight to cash and a flight to the dollar. And then it just kind of exacerbates the problem more. And then not only that, short sellers come in, and speculators that want to bet on, the price falling, they come in and push things down even further. And so margin calls, like when you have a very leveraged market, a ton of margin calls hits the market like a domino effect. Boom, one account, one massive account just got liquidated, sold those positions like really fast, a lot of them. More short sellers piled in, pushing the price down more. All that money or currency that was inside said asset is now in cash. Dollars getting a bid, interest rates are going up, bond yields are going up, relative and absolute strength of the dollar is going up, pushing that asset down further. And you can just see how when everyone has margin, you just start seeing these waterfalls of selling events as the price of said security that somebody has a leveraged position on just gets way out of its range and just way into dangerous territory on borrowed money, forcing a liquidation, forcing more of that to happen. Then the Bank of England's like, oh gosh, our credit market is getting unstable. We got to get in there and do something. So the Bank of England jumps in there and they start buying bonds, and that props up those bond prices in the credit market again, driving those bond yields back down, strengthening all those pension funds' balance sheets again, allowing risk assets too to start moving up. So even like tech stocks, like UK stocks, like FTSE 100 or whatever, stocks start to go up because now the Bank of England has stepped in and backstopped that little credit market. I say little, huge credit market. And that's the other thing. If you trade, I don't care, like Pokemon cards or pencil erasers or Bitcoin, like it doesn't matter, stocks, ultimately the price action of your asset is derived from what's going on inside the debt market and the bond market. So that's what you've been seeing all year. You know, it's not necessarily events that are specific to your asset class, like, oh, the Pokemon cards just got even rarer because somebody opened a booster and like set it on fire or something. It's not really what's going on in the Pokemon market, or Squishmallow market or pencil eraser market or Nvidia graphics card market. It's not really so much news out of there. It's what's going on in the thing that prices all these markets, which is the dollar, which is debt, you know. And ultimately the debt market, the bond market of all these countries and the bond markets collectively are so much bigger than even stock markets or real estate markets. So real estate, especially in this environment, isn't going to tell the bond market or the stock market what to do. It's the bond market that's going to tell real estate and stocks what to do. So it's kind of the headwaters, and instability in these bond markets all year, along with a hawkish Fed that, you know, is saying they're not going to do anything about it. That's what creates a lot of downward pressure in those asset prices, and then ultimately creates margin calls, and then even more instability, and then the central banks ultimately have to come back and cry uncle and help the financial system and abandon their quest to fix inflation. So I think the Fed's about to flip. Look for a Fed flip like tomorrow, like Wednesday. Like look for a Fed flip and then risk assets to go up. Just my opinion. I could totally be wrong. And maybe not, right? Maybe interest rates keep going up. Mortgages hit like 9%, then real estate prices really start to fall down. Bond yields hit like 5.5%. Interest rates hit, 6, 7. And you know what's funny? Even if the interest rates and bond yields go up that high, it still hasn't gone above the inflation rate and broken the back of inflation. So look for the Fed to pivot without having broke the back of inflation. Expect inflation to get worse. Expect all these government issued currencies globally to get weaker. And then when that happens and those central banks bring stability to those debt markets and those credit markets, when that happens, then you can expect those risk assets to start going up. So you see kind of mechanically what's going on. That's kind of like you're down and dirty on the markets. Like I think oil's about to start moving up. I think pencil erasers, squishmallows, old guitars, so, fine art on the wall, grandpa's pocket watch. Price tags are all about to start going up because inflation's about to get worse and the Fed's about to run back into save the day for asset holders and really trash the working class or people who are just leaving their wages pegged to the dollar and saving in dollars or peso, won, ruby, ruble, whatever. It doesn't matter. Yen's hurting, pound sterling hurting, and the dollar is in relative terms doing extremely well, but in absolute terms hurting as well. So time for those things to hurt some more and risk assets start going back up, in my opinion. Other thing going on, Nord Stream pipeline, Nord Stream 1 and 2 got blown up by somebody, so a bombing, okay? Not a accident. Somebody's intelligence agency or multiple intelligence agencies probably know who did it or what's going on, but as of right now, nobody really knows who did it. Cui bono, who benefits? There's a lot of potential people. So you have like Putin could have done it, Russian hardliners could have done it, America could have done it, a faction inside of America could have done it, Ukraine could have done it, German hardliners could have done it, even though they're the ones cutting off their own energy, so I doubt Germany did it. Who knows? The UK, some G7 country, somebody with some pretty good special technical capability pulled that off. So I would look for rich, superpowers essentially, or in their respective intelligence agencies. Weird though. Big thing to highlight, it means that critical infrastructure is like totally a target now. The wars of the future are going to be so much more asymmetrical than conventional. So instead of just thousands of guys over here, thousands of guys over here, blah, hell, what came out of it? It's going to look something more like what you're seeing. Little underwater drone blows up a pipeline or a depth charge, or maybe even explosives sent down a pipeline, or a drone flies a missile into a dam, or somebody shuts down the power grid, EMP, it's going to poison the water, something like that. It could start to look a lot more asymmetrical. I think that's a feature of the future of war. It's not really people shooting bullets at each other. It's like murder drones coming to get you, like a swarm of 8 murder drones that can like fly 200 miles an hour are just going to come find you and kill you, crazy stuff going on. So I don't know who done it, but just makes the case for high energy prices over the winter that much stronger, especially for Germany. So that stinks, that's rough. And children, right? Hurricane Ian blew through. Horrible thoughts, prayers go out to the victims. Gosh, one of the most expensive storms in Florida history, and perhaps quite deadly. Okay, so really sad and super bummer. That really sucks. So thoughts and prayers go out to those people. Rebuild. It's got a long road ahead of them, and I'm not sure how many of these people had like flood insurance and stuff too, right? Very, very bubbled up area, and then a lot of people just moved there, so just horrible. So yeah, you got rising interest rates, rising bond yields, rising relative strength of the dollar, Hurricane Ian, Nord Stream 1 and 2 being bombed, so pipeline sabotage in the Baltic. Yeah, crazy stuff going on. It's really about it for right now. We've had two quarters of negative GDP growth, so we are in a recession, have been in a recession all year. It's whether or not the Fed wants to keep tightening until something breaks, which Stanley Druckenmiller, Jeff Gundlach saying there's a good probability something already did break, meaning the lag of these tightening policies are going to eventually hit the market, cause a hard landing. Okay, well, then we're going from recession to depression if you think that's going to be the case. 4 quarters of negative GDP growth, that's quite depression-y. So I can't tell you whether we're in a recession on our way out. I think we're on our way out, at least for asset prices. I don't know about the middle class or lower class, but I think we're about to ramp up out of this recession in asset prices. So things like NASDAQ, gold, Bitcoin, oil, stuff like that. But could we be in a recession, about to enter a depression? Well, we're just going to have to see. Looks like third quarter is going to be negative. So we're going to find out how much money the Fed is about to print on their Fed pivot. Going to make inflation worse. But what other choice does the Fed have at this point? They should have raised interest rates in like 2015 and not, to 2%. They should have raised interest rates to 7 or 8% on the Fed funds rate back in 2015. That's how far behind the Fed is with regard to their interest rate policy and monetary policy. But also, that's not an accident. It's not like the Fed was asleep at the wheel or the Fed made a policy error. The Fed is not behind the curve. The Fed is the curve, and this is all by design. Fed's got to stop raising interest rates, because even like the U.S. government that's borrowed a lot of cash, they need to keep their debt servicing as low as possible. And I don't think the IRS is bringing in the tax revenue to even service the debt if the interest rates keep going up. So debt-based monetary system, Fed's been trying to fight inflation and tighten, but it's not looking too good. And even if the Fed does keep raising interest rates, it's still not going to fix inflation. They would have to raise so much more and roll off their balance sheet. Their balance sheet is still like $8.5 trillion or $8.2 trillion or something like that. And I expect it to level off and then move higher, not get rolled off to $1 trillion like they've been telling you. So the Fed can't dump all those assets they added to their balance sheet just into the open market. I don't think they can do that. And I don't think they're going to. And they can't keep raising interest rates, so I don't think they're going to. I think they're going to enlarge their balance sheet and lower those interest rates, lower those bond yields, causing the price of risk assets to go up. And hopefully the labor, being something with a price, goes up with it. I'd really like to see labor doing the cost of capital. It's really destroying everything. So I look for the Fed pivot. All right, that's really all I got for right now. Hope this finds you doing well. Like, subscribe, share, whatever. I hope you got something from this, and just my opinion, I could totally be wrong. So